Welcome to Orange County Power Players, where we spotlight the personal, professional, and financial success stories of OC's top leaders. Here's your host, Danny Flores.
Welcome back to OC Power Players, where I interview some of the most successful people in Orange County. I'm Danny Flores, your host, and today's honored guest is Scott Boren, zooming in from Irvine. Scott is the founder of Iron Point Insurance and Iron Point Agent Programs, plus Compare Quote HQ, helping independent agents grow and scale with carrier access and tech. He helps independent agents scale and compete with cutting-edge tech and carrier access. He spent his career in insurance product management, marketing, and operations, working with Geico, Farmers, and Esurance before launching Iron Point Insurance Services. Now he focuses on empowering independent insurance agents with tools, technology, and carrier access they need to grow. Through the Iron Point agent program, they help agencies unlock top-rated carrier access without needing direct appointments. And now with Compare Quote HQ, they've made commercial insurance quoting faster and easier than ever. Welcome, Scott.
Hey, thanks for having me.
That's an interesting place to be in the insurance industry, considering we all need insurance products.
Right, yeah.
Right? So how did you get started in the insurance industry, and how did you end up creating your current firm?
You know, it's in the insurance space, most people will tell you that they had no plan to be in insurance, and I'm no different than anybody else. I was getting ready for a career as a lawyer and planning for law school when I fell in love, got married, we had a child, and I had to make money. And what do you do with a political science degree?
Yeah.
Your intent was to be a lawyer. I decided to act like a lawyer. I became a claims adjuster.
Okay.
And, when I was working as a claims adjuster, I met this really interesting guy who was managing the product. And he and I just kind of grew fond of one another, and he gave me an opportunity to do something I had never thought of, something very analytic, something where I had to use my math skills. And that's kind of how it started for me. I had no intention to be an agent, had no intention to work in insurance.
Right. So then you get the shot, and I assume that you did really well then, because one, you have to like it, and two, you got a baby, you got to make some money, right?
You're right. You know what? There were some things that worked out in my favor. It was a small boutique, what's called non-standard auto insurance carrier. And the guy I was working for was kind of an important person to them. And he was managing the largest profit center in the organization. And I was the only other person who really knew how to manage the very unique state of California. And we were out here in Irvine. He was the only remote person in the organization. And he left. He got a better offer. And they're looking around the room and they're saying, well, who in the heck knows how to manage California? Oh, it's the kid, the kid who works for him.
Funny. Yeah.
So just by default, I got the job. I think it was probably earlier than management wanted me to have the job. But learning under fire is always really good. And the pressure accelerates the growth.
You got to figure it out. So then you take over the position, and then you grow that book of business for them?
Well, it was a fairly large book of business at the time. It was almost $100 million. I want to say that I did a good job. I was still very young and I was still learning. They asked me to come back and work in Wisconsin, where they were headquartered, and I didn't want to leave sunny California. So that's how I ended up at Esurance. I ended up going up to 5 Freeway to work with Esurance and manage product for them.
Okay. All right. So you leave them. They obviously didn't want you working remotely anymore. You go to Esurance, and what does that look like?
So Esurance was, it was fun. It was different. Esurance, we were, way ahead of the curve. Probably the first, maybe Progressive being the first to sell it exclusively online.
Oh, okay. That was during that transition period.
Yeah, this was, a long time ago. I'm an old man now.
Yeah,
Um,
right.
and yeah, it was a huge learning experience for me in how e-commerce worked, how data could be used to manipulate your
Hmm.
ability to process a workflow. So that kind of started changing how I viewed product and
Hmm.
distribution.
Right. Now,
And, and from there,
being
that's
one
how
of
Geico finds me.
yeah, yeah. So being one of the pioneers of switching online, and at that time, was that creating a lot of efficiencies in the system where they can actually be way more competitive than the rest of the competition?
So you would think so, right? That you're not having to compensate the sales counselors, the agents,
Hmm.
would tease out some inefficiency in your expense ratio. And in, I guess, in the purest sense, it would. And I'm sure a mature company like Geico does
Hmm.
appreciate some of those savings.
Right.
But it's not, it's not as pure as you would think, because as a small company for insurance, we had to spend a lot of money to get people onto the website. And it
Oh,
was
okay.
easy in the beginning because we were all by ourselves. And so,
Right.
somebody would, this is kind of predated Google. We
Right.
were very focused on Yahoo at the time.
Okay.
So
Okay.
somebody put something into Yahoo and we would show up, and that would help. But then you start getting other players, other insurance companies putting their
Right.
websites
Right.
out there and getting some of the traffic. And that's when we had to actually decide to spend money on television ads.
Hey, right. That's the competition, right? They start catching up. Now it's not a free reign on the internet.
Yeah.
So then you stayed for Esurance, and then what was your next jump?
So it was at Esurance where I got the phone call to come join Geico. And when you get that phone call, you take it.
Right, because you don't know what they're offering. What you want to hear what's going on.
Yeah. And they offered me the California Profit Center, which was for them at the time an underachieving state.
Hmm.
They had appreciated so much success throughout the country, but for
Hmm.
whatever reason, they weren't a number one, two, or three market share in California. And they were looking for somebody who had California experience who could help them think of a way to solve the problem that they hadn't, because of their model was very different in all the other states, and
Hmm.
couldn't be utilized exactly the same way in California because of our unique regulations.
Right. So elaborate more on why California is so difficult
I
in
wouldn't call it
almost.
difficult. It has challenges, without a doubt. Every state has them. It's just back in 1988, California voters, through a proposition, approved Proposition 103. And
Hmm.
Proposition 103 changed how auto insurance is regulated in the state.
Hmm. Hmm.
And before, we had a fairly free market approach to insurance. Now we have a highly regulated approach to insurance. And I think the thing that makes California most unique is that it's kind of a take all comers model now,
Hmm.
where if you qualify for a very broad definition called the California Good Driver, a carrier has to take you, and they have to take it, so they could really have just one rate. Um,
Is that one rate across all insurance companies?
no. We all can set our own rates,
Right.
but the rating variables we can use are prescribed by the regulation.
Right.
So we can choose to use them or choose not to use them, but we can't go beyond the ones that are approved for use. And then they have a prescribed sequence that they have to go in, and their order of importance have to be solved in a certain way that you show that variable A is better than variable B, is superior to variable C, and on down the line. And if you can't prove that, you can't use the rates. But you can use your own data. You can use your own unique factors and base rates and everything. But that's what makes California different. And that take all comers approach to it. If you have a model that wants to take all the variables and say, okay, you are this type of customer, and you are this type of customer, you are this type of customer, you really can't do that here. And even though the market kind of lends itself to that, where some people
Now, is that because of driving record? The different types of customers become different types because of their driving record, age, maybe?
all these variables are important.
Right, right,
You would be surprised at what things are predictive of your ability to drive well on the highways. Age is one. Our
right.
experience, our ability to get behind the wheel and use the vehicle,
Yeah.
without a doubt, is an important variable. But there are other variables that are more important than that.
So you guys have so much data. You in general as insurance companies have so much data on age, married, not married, years of experience that you guys can almost predict your actual cost per customer.
That's the goal. That
Uh-huh.
is absolutely the goal. The problem for insurance modeling, different than like marketing modeling or something like that,
Right,
is in the model, the response variable is what you're measuring is, if I do this, I get A. If I do this, I get B. If I do this, I get
right,
C. But you
right.
always get some response, right? In certain
Yeah,
models.
yeah.
In insurance, it could be, a married male, 50, driving this car in this territory with this insurance score and this prior experience, and all these things, but he
Right.
never has an accident. So I have no response variable. I don't know if you crash your car a lot. I know you don't crash your car, but a lot of them don't crash their car. And so that's
Right.
the biggest problem. The frequency of loss is very low. It's very low.
Yeah, no, that's interesting. Interesting. You would think that the cost of the insurance will be reflective of that
And it
across.
is.
Oh,
It is. It's just the tightness of the fit when you statistically fit these models to their data.
hmm.
I'm going to get really wonky and technical on you. The spread between where you fit the model up into the
The
data
cost,
is
cost.
big. It's
Yeah,
big. It's not as tight as other models. So
right,
what we I guess what we would say is they're useful. They're
right,
directionally useful, very powerful in predicting loss, but they're not like other models. They just don't have the same response variant
right.
models have.
So now based on that and based on how highly regulated California is, if you had to change any of that, what would you change?
You know, because of the nature of competition, it's the biggest market in
Right,
the United
right.
States. There isn't one insurance carrier who wouldn't want to find a way to conquer this market and be number one.
Mhm.
So I think you can relax these rules that are put upon the insurers, dictating, the order and the sequence of the variables that they use. Let them express whatever discounts they want to express. Choose the way that they model out pricing. Because at the end of the day, the spirit of the law that dictates today how we
Mhm.
price it was one that was you don't want to price on something that wasn't real or didn't have a real driver of the risk that you were insuring. And
Mhm.
the model that California uses today was based back in 1988. And we didn't have the statistical tools or the memory. Just think of
Right,
memory as one thing. We couldn't store this much data to do a
right.
model. And so the prescription by the actuaries from the department back then was this thing called a sequential analysis, which tries to, tease out what's explained in the step before and not
Right.
express it in the next step. But today, insurance companies use multivariate tools and they solve the entire model simultaneously, or they'll tie off parts of it, solve certain parts in a sequence. But the idea is to not express the part of risk that's being explained by, like, say, your age, that is being explained by something like your gender or your marital
So
status.
in a perfect world, let's just say hypothetically speaking, and is this related all to Prop 103 back in the day when it came into effect?
Yeah, so Prop 103, we had a rating system that allowed us to do that. Prop
Right.
103 then changes it and says there's three variables that you have to use. It's your age, your experience,
Mm-hmm.
your driving record, and
Mm-hmm.
the third one is annual miles driven. And so while miles very powerful, we didn't have the tools to track miles back then. So you could say whatever it is, and the state says it's prescriptive. So anybody can say, I drive 2 miles a year. And then you get the lowest rate that they have available for miles. And so it's unfair. Well, today we have telematics devices that'll tell you how far you drive. Your car will tell you how far you drive.
Right. So then they need to go back and maybe they have to change Prop 103 and vote a different one in to kind of modernize the way pricing and risk is assessed, right?
That's absolutely correct. But overturning a proposition is difficult.
Right. Exactly. So probably won't happen. So we have to continue with this antiquated prop controlling the pricing of insurance.
Yeah. And some of this is playing out right now. I'm not sure if you've had the experience of trying to go out in the market today and buy insurance.
It's expensive.
It's very expensive right now, and it's hard to get. And it's all based on these rules that were created in '88 that over the years, the insurance companies have found ways to survive. They either get more efficient in their back office operations, or, something has happened. They pay the agent less than they would in other states. Something that makes it a little bit easier for them to make money. And that had worked fine for many, many years. They just have learned to adapt. And then COVID happened. And when COVID happened, the Department of Insurance placed a pause on letting insurance companies take rate as a way to give the consumers a break, because we were all struggling at the time. But they let that go too long, and they were a little bit too rigorous in the application of it. And so you had insurance companies who maybe hadn't taken rate before COVID happened for a year, maybe a year and a half. So their rates were set based on 2018 and 2017 data, maybe 2019 data. And then they were paying for claims that were experiencing inflation post-COVID. And they couldn't pay for that. They couldn't do that. So to their credit, they didn't non-renew all their policies. They just stopped selling new ones. They didn't want to make the problem any worse. They're only now getting to the point where they're returning to profitability, and they want to open themselves back up. And then property saw another issue. It has to do with wildfire. Back when you and I were younger, wildfires would happen, but they weren't a normal everyday occurrence for us. Now wildfire seasons are upon us. We have a season, and we have to adapt and plan for wildfires, and insurance companies are the ones who have to foot the bill generally. And, there's no real provisions in the law and the regulations that allow for them to pay or charge additional rate for catastrophes associated with wildfire, or to avoid them. And so their only option was to say, no, I don't want to write right now. Otherwise, they were exposed to writing in wildfire areas.
So does that mean they exit the California market, or they just cease to write new policies in the California market and let the other ones burn off?
It's been a combination. You have some, and the one that got all the press was State Farm, right? They get a lot of press because they're big. They decided not to sell anymore. And when they decided not to sell, that was a big drag on the market, because they were probably writing, a ton of homeowners policies. But before they even made that announcement, I'm here to tell you, Liberty Mutual had already stopped. Travelers had already stopped. MetLife had been acquired by Farmers. Allstate had acquired National General. So the market was already shrinking before it even stopped. That they got press for it. So the problem preceded, any news publication even knowing about it.
So now I don't know if you know the answer to this question. How many choices does a homeowner have to get quotes on fire insurance if they're in the city, and how do they change if they're in closer to fire areas, maybe mountainous regions?
Yeah, if you're in a fire area, especially one that is determined by the FAIR plan to be, absolutely exposed to fire, you're probably not going to get a policy. You're probably
period, like no policy, nobody will write you.
Not a homeowner's policy. You'll get what's called a homeowner's policy with a difference in conditions endorsement on it. And that difference in condition endorsements then takes out fire as a peril that it'll pay for. And
So
then you
what
have to go
happens
to the
with the
state.
mortgage companies that need you to have fire insurance for the home they've
This,
made a loan on?
yeah, the state provides it then under the California Fair Plan.
So do you get a combination of policies, or do you just go to the California Fair Plan?
You go to your same agent, then your same agent will try to find a homeowner's policy that'll sell it with that difference in conditions endorsement on it. Then you sell them the companion fair plan. So it's like two homeowners policies. Sometimes they cost the same.
The same as one, or the same each?
Yeah, so I like an example. There is a gal who's been insured with us since we opened in 2010,
Right.
and she was for the longest time insured with Safeco. Safeco no longer wants to write the area, so she's asked us to find a new place for her. And because she's been around for so long, I helped her myself. And it's going to be a difference in conditions policy, which is almost $2,000, and then the fair plan, which was like $2,400. So she's a little over $3,000 probably for her policy, and her former policy was like $1,500.
That covered it all.
Yeah, it covered it all.
Double.
Yeah, for like 10 to 15 years, she was with Safeco. Everything covered on one policy. She's had one claim in that whole time, and now she's got to pay for two policies and pay more. And she's probably the exact same risk, won't have another claim for another 15, 20 years.
So the question would be, and maybe we don't know the answers, what can the insurance commissioner do to fix that?
It is a hard problem. And, the insurance commissioner is not a professional insurance person. He's an elected official. And he's doing his best, to get his feet underneath him and understand the things. And I'm sure he's a very smart man, and he's learned a lot along the way. But had he been a true insurance professional, we might have had a solution by now. And that solution would have had to been something where you work with the regulators, you work with the legislator, and find new law. Because the problem is the current law doesn't allow for insurance companies to set up the pricing that they want and they need in order to protect from, you could have State Farm, like Paradise, that city of Paradise. I think State Farm insured like a majority of the city of Paradise, and the whole thing burned to the ground.
That's a big loss for State
That's a
Farm.
big loss. Yeah. And so that's the thing that they struggle with.
Yeah. I mean, you can't pay out claims from money that you don't have. So I get that they have to charge what is the risk, right? Yeah.
And the thing that we as consumers then look at it and think, oh, but State Farm has a lot of money. They do. They have a lot of money. And sure, they could pay for that. But they don't plan for it in a way where they can go and take the reserve money out and pay losses. The objective is to take in premium for the year, and that premium will cover the losses with, roughly maybe a 4 to 6% profit to them. And then any return on investment for monies that sit in reserve or are unearned at the time because somebody paid too much or something like that.
Right.
And then they make some money off of the surplus that's in the bank. But it's not designed to, I owe $2 billion now. I'll just dig that out of my savings, break the piggy bank, and pay that. They can do that, but that's not how it's designed. And that's why you see them responding to that, because they want to get that $2 billion back, put it back in the piggy bank, and then start building upon the reserve.
Right. Yeah. I mean, they have to be, that's their business model, right? And that's how they stay in business.
And it's beyond that. State Farm, the Hartford, these big carriers, they have redundancy of capital. Pretty sure they don't feel like it, but they have redundancy of capital. So they actually make the rest of the market work, because they can take some of their money and put it into either reinsurance markets that bolster up smaller companies that need that, or even just inject some of their capital into other companies as a reserve note and help them write. So it's beyond what they do for themselves. They're actually building up the entire market in a lot of ways.
Right.
And so, every time one of them takes a hit, the whole market kind of feels it.
Right. So now that we talked about, your career path and kind of the issues that are occurring in California, how does Iron Point come in and say, okay, we have some solutions here, we can help?
Yeah, there was, years and years ago, I was director of research and development at Farmers, and one of my closest friends was the director of insight and innovations. That was the consumer side, I was product side. And we were talking about what Farmers does. And the one thing that Farmers was really, really good at was bringing in new agents, teaching them how to be great counselors and help the customer. Farmers' product isn't always the most competitive, yet they maintain such a large market share, largely based on the quality of these really good agents. So my history, I had learned a lot about the independent agent space, and I knew a lot of people in the market. And he and I got to thinking, what if we took the Farmers model, kind of the way that they sell, the counseling, the care, and we gave them 4 or 5 products that were of similar quality to Farmers. What could we accomplish? And that's where we came up with this idea of the Iron Point agent programs, where we would bring in smaller agencies or agencies interested in working with us and aggregate them underneath us so that they can.
These are like independent agencies, not Farmers, not AAA, not just somebody different that has a small.
They mostly have to be independent or exiting a captive relationship, because a captive relationship, their contract says that they have to write the products that their host company provides unless the host company doesn't provide it. It's generalizing, but that's essentially the nature of their relationship with their host.
Right.
So we have to work with independents, those that are free to choose who they work with. They just can't work with the captive companies. So the captives would be like Farmers, Allstate, some of Nationwide. Nationwide does both, and State Farm.
Okay, so an independent one can't use any of those. If you're within that company, you can't use anybody else. That's how it works.
Independent companies can choose who they work with, and it would be somebody like a Travelers, a Hartford, Liberty Mutual, which is also Safeco, and companies like that. They work through independent agents.
Okay, so you guys come in and you work with these companies. What do you do for them, and how do you help elevate their productivity?
So there's 2 pieces to it, right? Go to the carriers first and explain to them our philosophy and how we intend to manage risk so that they don't lose money on our distributors. So that was part of that, bringing to the conversation my background, my experience, and then my former partners' background and experience in the models that we wanted to run inside of Iron Point that would help them choose and select the best customers. And then for the agent themselves, they would get access to our carriers in our portfolio, which aren't easy to get. Getting a contract with Liberty Mutual or Nationwide or something like that requires a commitment of premium or policy sold, and a lot of people just can't hit that and have all these carriers in their portfolio. So we can aggregate them underneath us, give them access to these markets, and then in turn we also provide them the ability to learn how to operate their business, how to market their business, how to hone in their sales craft, and things like that.
Wow. Okay, so that's kind of a great model there. Collectively, that independent agents, you can give them access to what they need because they don't have to hit these hurdles individually, but as a group, you hit them and you have access to these companies.
Yeah.
Now,
kind of like what a Farmers would do for them.
Right.
Them, provide them the products, and then train them.
Okay. And then their productivity soars through the roof. So you would expect, and everybody's happy, right?
Yeah, there is a, still going back to the old Nike thing, just do it. There's still the just do it part of it. I can lead you there. I can show you the tools, teach you content marketing, teach you social media marketing, teach you how to, set up videos and do all these things. But at the end of the day, you've got to do them. And then the one thing that we learned when we started this right away is that, coming from big budget companies, Geico, Farmers, we had money and resource. I didn't bat an eye if I needed new software or something like that. We just buy it, and we could run commercials. And so I had a marketing mindset when I came into this, and it was a philosophical change I had to learn that this is also sales. There's a lot of interpersonal relationships that are developed between the agent and their policyholders that I was not aware of at the time. So there was some tripping and some failing as we started.
Right.
Yeah, and
That's the entrepreneurial spirit, right? It ain't glamorous like people think it is. You got to pay your dues.
Yeah. So our first iteration of the model was a massive failure. Because it was very marketing focused. We thought, if we do these things like I did at Farmers, people would come to the websites, people would make the phone ring, and you'd sell all these policies. Yeah. And that wasn't true at all.
Right. Now, besides that, do you sell policies too? So are you doing kind of two things at once?
There is no way to avoid the fact that we had to create the facade of an agency. So that, because everything goes out, it says Iron Point Insurance Services on it, whether or not, they're somebody who has a location in Alhambra or San Diego, it's going to say Iron Point Insurance Services on it. And they'll call the 800 number. Or they'll just go out and start searching for things. So we had to have the website up and everything. And because we're kind of good at it, just by natural inertia, people would call us. So we do sell directly as well, but we try not to go out of our way to do that because we're not in the business to compete with our agency.
Right. Wow. So that's great coming up with that. And you said you've been doing it since 2010.
That's when we opened the doors. Yeah.
Yeah. And so what would you say tell us a story of one thing that was a great challenge that you had to figure out and overcome, like a trip hazard here as an entrepreneur or creating this business?
Yeah, I had when I was working at Farmers, we had this group that worked with us, and they were an analytic group that we could outsource a lot of our predictive modeling and some of the multivariate stuff that we were working on, and they were embedded inside the office. We got to know them. And I was out to lunch with them. They're very entrepreneur. This was their business. It was a side hustle. I think it started for some smart math guys, and it turned into a business. And we were having lunch, and they were telling me about starting their business. And they said, you know what? It's lonely. It's very lonely. Nobody cares how you're doing but you. Maybe your wife, right? Nobody really cares. They're out doing their thing. And that, I think, was abstract to me at the time because I was collecting a salary.
Right.
And then I get to Iron Point, and I'm not collecting a salary. I'm actually putting money into it to build it. And, a day could go by, not a single phone would call, no email come in. And it's like, whoa, this is lonely. And so I think the thing that I learned the most was that if I didn't do it, if I didn't get up and make something happen, it wasn't going to happen.
That's exactly right. There is nobody telling you, do this, do that. You got to hit your KPIs every quarter. Nothing. It's all you.
Yeah.
And that's an entrepreneur, right? We have to be self-driven. We have to be responsible. I've had people sometimes say, oh, you know what? You have your own business. You can sleep in and do whatever you want. Well, guess what? We have more responsibility than everybody else does.
Yeah.
Because when 5 o'clock comes, the responsibility doesn't stop. It's 24/7.
Yeah. And here's the funny thing. So we're a fairly large agency now, by the pure nature of the aggregation. We just have a lot of policyholders. So, a lot of people will say that same thing to me, you get to set your own schedule, you get to do your own thing. It's like passive income for you, right? And you don't have a boss. And you always have a boss. There's somebody who you work for, whether it's these carriers that want something more from me or something different from me, they're my boss. But in reality, the 10,000 plus policyholders, every one of those
a lot of bosses.
My boss. And they could call, and on the weekends we're kind of closed, but that phone will ring on the weekends, And if they keep ringing it hits my cell phone,
Yeah.
because I know somebody has a problem.
Right.
I will be in the middle of a dinner party or something like that, and it just keeps ringing over and over again. Someone needs to reach us. I'll pick it up, and I will ask them if they're okay and make sure that there isn't something super pressing, and give them direction on how to solve that problem right now, even though we're not available.
Yeah. No, that's the way it goes.
Yeah.
Now, one big question: if somebody's listening to us and they want to get into the insurance business, which route is, I don't want to say the easiest, because I don't want to say it's easy. No business is easy. You got to get in there, you got to build it, or maybe you buy it. So maybe the question would be, do you want to buy into an agency, or do you want to build your business? One, do you want to go with your other carriers, your AAAs, your farmers, your state farms, or do you want to go the independent route, and why?
Yeah, there is no easy answer to that, because each path has pros and cons to it. Going the captive route, you're getting support right away. So you would have probably some kind of a district manager or regional person who is taking you under the umbrella. They're teaching you, maybe giving you office space, and the ropes are being handed to you. But then you're limited to do what they want you to do, right? Income might be harder to come by. If you go independent, it's hard to get these contracts, hard to work with these carriers right out the gate. So you might have to do something you didn't want to do. You wanted to sell, high-end homes, you wanted to work with the Chubbs and the Aces and stuff like that of the world. You don't get to do that right away. You've got to first start somewhere and prove to them that you have the capacity to do this. So that's a hard road to go. You kind of have to decide, what do you want from it, and how long can you wait to make money? The beautiful thing about an insurance agency is that capital cost to start is very low, but revenue is hard to come by. So, now,
is that revenue in the beginning till you build your book of business?
Yeah.
And
so
how long does that last?
Yeah, because it works almost like an annuity.
Yeah.
You could sell $1 million of premium your first year, and if you could do that, you'd be phenomenal. You'd set, people would talk about you, but you probably only make $120,000 of revenue that year, and you still have to pay for the expenses for your office space and
I was going to ask that. Right.
And selling $1 million creates phone calls, so you need staff and you need help, so you've got to kind of pace yourself into it, and you need that book to kind of feather itself in over time,
right?
Because you make your money off the renewals, really, because they're settled in, they're making fewer changes, need a little less understanding of what the new product was that they just bought, and so it's hard to get going. So I think you had asked me earlier, what was something you learned? I think the other thing that we learned was that we started it from scratch. So I put in money, my partner put in money, and it wasn't enough money. And we should have bought an agency that had existing cash flow. And it was another rookie mistake, because I'd come from what I thought was entrepreneurial product management, profit center management for insurance company, where I had a lot of control, but it's not entrepreneurial because I was using their cash flow. I was using their revenues. I was using their existing infrastructure. And so I should have bought an agency. So I guess if my advice was to tell anybody what to do, is find somebody who would be willing to sell their business to you, work with them for a short amount of time, learn the ropes, how they did things, get that foundational understanding of the business, and then pay them for it and buy it, and then try to put your thumbprint on it
and grow it, right? Because now you have something that's you're not going to be not getting any money. You grow the business, and then it's all you from there, right?
Yeah. There were times in the beginning, because I didn't do that. I mean, we started in 2010, probably roughly around 2013. It wasn't enough revenue, and I was running out of money. And there were times where I would go to bed wondering, what in the world did I get my family into? I had a very high salary working for these companies. I should have just found another job.
Yeah.
Yeah.
But how about now? Let's ask that question now. Do you have any regrets?
I don't. I don't.
Yeah.
Yeah, it
You had
is.
to pay your dues, right? That's the thing is that you got it ain't if it was easy, then everybody would be doing it.
Right, right. And now I have the luxury of trying new things. And so
Mm-hmm.
one of the things that I invested our money into was building out an online infrastructure to sell tourist policies to US and Canadian citizens driving into Mexico.
Mm-hmm.
So we created MexicoCovered.com a short time ago. We're playing around trying to get it optimized and tuned and get more traffic onto it and compete in that space. It's a much easier space. The threshold's lower to compete for those clicks than for auto insurance. And those carriers will give me the ability to sell it online versus some of I can't sell all travelers won't let me sell their product online. I can't connect them to their payment gateway. But the Mexican carriers they want that. They're looking for partners that'll do that.
Right. Make it easy for them.
Yeah.
So as we wrap up the interview, what do the next 6 to 12 months look like for you?
So the next 6 to 12 months, what we are heavily invested in right now is CompareQuote HQ. So that is a platform that we developed because we're pivoting away from personal insurance because of its difficulties in the marketplace to commercial insurance. And we partnered with a company called CoverForce, and they gave us the infrastructure to make these API calls out to the carriers. And now we can aggregate quotes through the process. So when agents join our membership group, now they can log into CompareQuote HQ if they're quoting a restaurant or a medical office or something like that. They can just go in there and they can do the business owner's quote or the workers' compensation or cyber liability and get a quote right there. If they like what they're getting, they can go directly from there into the carrier and sell the policy. So we're real focused now in getting more of our members to come in and come through the portal. We're almost transitioning into becoming a software company.
Nice. Congratulations on that, Scott.
Thank you.
Now, thanks so much for sharing. I mean, this is a great story, great insight on the insurance industry in California, great insight on how the different companies work. Now, if somebody's listening to us and they'd like to get a hold of you, how could they get a hold of you?
We love digital, so just going out to ironpointinsurance.com and you can find our website or you can do a quote online. If you're looking to partner with us, you can go to ironpointagent.com, learn about the program, and then you can schedule an interview with me and we can talk about whether or not membership is the right choice for you.
Perfect. Well, thank you so much, Scott, for coming on and sharing. And to our audience, please go to ocpowerplayers.com and follow us on your favorite channel. Thanks, Scott.
Thanks, Danny. Appreciate it.
Thanks for listening to Orange County Power Players. Want to share your success story? Apply to be a guest at ocpowerplayers.com/guest.